That was funny. That was funny. That's funny. That's funny. Mm. 9 pages. New clients, legal liability, and materiality. Let's see. 6 to... Oh, crap. That's not very long. Dude, that's literally less... That's a smaller reading than the last reading I did. Okay, I was not expecting that. Well, I'll read it once, and then I'll do the auditing standards, and then if I have time afterwards, I'll read this again. I don't know. Never mind, I'm probably just going to read it once. Reading it twice last time didn't help me at all last time, so... Like, I still couldn't participate in the discussion, even though I read it twice. Because reading it is not enough, apparently. During August of 2010, the Virginia-based CPA firm of Abernethy and Chapman underwent a peer review of its quality control procedures and its quality control document. Although the final report of the outside review team was favorable, it did criticize the lack of control demonstrated in accepting new audit engagements. Until that time, this decision was left solely to the managing partner, who often made little or no investigation of a potential client before committing the firm's services. The review team pointed out that this policy failed to protect the firm against being involved in engagements with undesirable clients. Following the peer review, Abernethy and Chapman created a 3-partner committee to screen each potential client. This group, called the Client Screening Committee, was empowered to make the ultimate decision as to whether the firm should actively seek a particular audit under guidelines established by this committee. A partner was put in charge of researching any possible new engagement. This partner had to complete several forms and provide other data describing every potential client. The partner also had to attach a final recommendation letter evaluating the wisdom of seeking the audit. The committee would then review all of this documentation and instruct the partner as to the appropriate course of action. The addition of a client with potential plans to go public in the next few years will bring Abernethy and Chapman under the regulations of the PCAOB in order to adequately plan this increased regulation and impact on the firm's practice. Richard Abernethy also asked Bob Zimmerman to evaluate... Who the heck is Bob Zimmerman? Jeez. To evaluate how their client review process would interact with the registration process. The partners are now considering whether they wish to become registered and are actively assessing the resources they would need to commit to such a strategy. Regardless of the decision to become registered, Abernethy and Chapman's client review process requires the following 2 documents to be completed for each new engagement: analysis of potential legal liability and information from predecessor auditor. Before completing these forms, the in-charge partner learns as much as possible about the potential client and its industry. For example, either the partner or a member of the audit staff reviews recent annual reports and tax returns, tours the company facilities, reads any applicable AICPA industry audit guides, and talks with the business references furnished by the potential client. In addition, the partner always discusses the new engagement with the company's predecessor auditors to keep from burdening the predecessor auditor with inquiries from numerous firms. The discussion is only made after the engagement has been offered to a specific new firm. In investigating the Lakeside Company, Richard Abernethy was aware that much might be learned from a conference with the predecessor CPA firm. King and Company. Once the Lakeside engagement had been offered to Abernethy and Chapman, the partner began to seek a meeting with the predecessor auditor because of the confidential nature of audit information. Arrangements for this discussion were made through Benjamin Rogers, president of Lakeside. An appointment was scheduled for June 15th, 2012. So that Abernethy could talk to William King, the managing partner of King and Company, at this meeting. King did not appear to be surprised that the Lakeside Company was seeking a new independent auditing firm. He talked quite candidly with Abernethy about the engagement. I assumed when we qualified our year 2011 opinion that it would be our last year on the job. Rogers is really interested in stimulating growth and becoming president of a large company. He never talked about going public with me, but I am not surprised. I am positive that he did not like taking that impairment of value problem to his stockholders or to the banks that finance his inventory. That could scare them and put a damper on his expansion. I was comfortable working with Rogers. He and all of the members of his organization appear to be people of integrity. However, he was always unhappy with our fees. Have you discussed with him how much the audit will cost if he goes forward with his public offering? I honestly don't believe that he understands the purpose of an audit or all of the work that the job entails. I must admit that Rogers argued vehemently against writing down the reported value of the sixth store. He based his arguments on 2 points. First, that no real impairment existed, and second, that even if Store 6 represented an impairment, the potential loss was not material. As to the impairment issue, our firm was never able to satisfy itself that Lakeside was not going to be stuck holding a totally worthless building in a failed shopping center. Rogers simply disagreed. He could only see the most optimistic possibilities for that store. Unfortunately, the materiality question was even more complex. The company has a net investment of approximately $186,000 in that store out of $3.6 million in total assets. Rogers contended that at the very worst he could sell the building for around $100,000. Of course, that's all in his crystal ball. We obtained an appraisal that came in at $150,000. With the company having a net worth of less than $1 million, our partners felt that write-off of the potential asset impairment was absolutely necessary. When he would not recognize this loss, we felt that a material misstatement existed within the financial statements and a qualification was required. The company's situation is really quite unique. The audio and video equipment retail stores are only marginal operations. Rogers ruined them when he turned them into Cypress outlets. The market in the Richmond area is just not strong enough for that particular brand alone. On the other hand, he has done exceptionally well with the distributorship side of the business. Across Virginia and North Carolina, a very large potential demand seems to have developed for Cypress products. I can see why he is planning on major growth in his distributorship business. Rogers is just now beginning to tap into that market. Consequently, he is trying to operate one stagnant and one prospering business at the same time. I certainly foresee the distributorship sales growing rapidly over the next few years. I will be interested in seeing how well the internal systems of the company are able to adapt to that expansion, especially since Rogers dislikes spending any money. Does he know what it will cost to meet PCAOB standards in the area of his internal control? Before ending the conversation, King assured Abernethy that their audit documentation of past examinations would be available for review if Abernethy and Chapman were retained to do Lakeside's current audit. The audit documentation of King and Company consisted of a permanent file of information gathered about Lakeside and annual files containing all of the evidence accumulated during each of the previous yearly examinations. If the firm decides to accept this engagement, then the engagement team must establish a preliminary judgment about materiality. This judgment normally takes place during the planning phase of the audit. However, due to significant uncertainty surrounding Store 6, the client screening committee asked Wallace Andrews, a manager in the firm, to complete the form, a preliminary judgment about materiality, to see just how material a potential write-down of Store 6 would be. Andrews must decide on the combined amount of misstatement in the financial statements that the firm would consider material. Materiality is the amount of a misstatement on the financial statements that makes it probable that a reasonable user of the financial statements would change his or her decision due to this misstatement. For example, if the net income of Lakeside was overstated by $1 million, would that change the decision of a creditor to loan money to the company? What if the income was only overstated by $100? That was funny. Andrews will consider both quantitative and qualitative factors in determining the preliminary judgment about materiality. He knows that materiality is a relative rather than an absolute concept, meaning that the size of the client impacts the level of materiality. Because materiality is relative, it is necessary to have quantitative bases for establishing whether misstatements are material. A base is a critical item of which financial statements users tend to focus while making decisions. The base will vary depending on the nature of the client's business. Typical bases include net income before taxes, net sales, total assets, and stockholders' equity. For example, Wallace might determine that 3% to 5% of net income before taxes is a reasonable range for the quantitative part of the preliminary judgment. Wallace will also consider qualitative factors. Certain types of misstatements are likely to be more important to users than others, even if the dollar amounts are the same. For example, misstatements that involve fraud may be more important to users than misstatements due to unintentional errors. Fraud reflects on the integrity of management and other employees of the client. For example, if the firm suspects fraud, Wallace might choose the lower end of the range determined in a quantitative part as the preliminary judgment about materiality. And it only took me 14 minutes to read that chapter. Now I have to study for the quiz, starting at 9 a.m. right now. So, did I download all the files for this week yet? $550, $560, $580, $585. week 8. And I saved the important stuff from each one. I think 585, I include literally the entire thing. Oh, jeez. And I was considering maybe, I wonder how many pages I have to read for each one. I guess I do have time to figure that out. I don't know. Did I download these yet? I don't think I did. 550. No, I didn't. I still have to download these. And I don't know. I mean, I do have time to read all of the sections, I think. I mean, other than the applications. We have like 25, 14. You know, it's not going to take that long to write down all the thingamajigs. That was funny. I'm just going to write down the number of pages I have to read and the number of paragraphs. That was funny. So, when is he ever going to grade our past 2 quizzes? Still hasn't graded them yet. That was funny. Whenever the only notes I take in class are which sections he talked about in class. That's all I do, except for this stuff here. Need for disclosure, fraud, risks. Well, whatever that means. So for 550, we have to read. Oh man, 9 pages. So it's going to be 930. That's what I do this. That's what I'm doing now. 9 pages, 30. Man, 9 pages. Man. $6.20. $6.20. Oh man. This is long. This is longer. This is gonna take a long time. 526. This is a much longer reading than all the previous readings. Gosh dang it. Gosh dang it. Well, this one's way short. This is 2.8. This is like one of the shortest ones we've had. Um, 15, 20, 22. 7, 13, 22. 50, 76, 84. Crap. 84. 34, 54, 84. 22 pages, 84. It's not that much longer. It's only like 2 pages longer than last week, I think. Gosh dang it. I don't know if I even have time to read all that. I think I do have time, though. I don't know. I think like last time I read all 20 pages twice. Like, so I should have time. Skipping some stuff I don't need. Many related party transactions are in the normal course of business. In such circumstances, they may carry no higher risk of material misstatement of the financial statements than similar transactions with unrelated parties. However, the nature of related party relationships and transactions may, in some circumstances, give rise to a higher risk of material misstatement of the financial statements than transactions with related parties. For example, unrelated parties. Related parties may operate through an extensive and complex range of relationships and structures with a corresponding increase in the complexity of related party transactions. Information systems may be ineffective at identifying or summarizing transactions and outstanding balances between an entity and its related parties. Related party transactions may not be conducted under normal market terms and conditions. For example, some related party transactions may be conducted with no exchange of consideration. Related party transactions may be motivated solely or in large part to engage in fraudulent financial reporting or conceal misappropriation of assets. Responsibilities of the auditor. I don't want to read this. Because related parties are not independent of each other, financial reporting frameworks establish specific accounting and disclosure requirements for related party relationships, transactions, and balances to enable users of financial statements to understand their nature and actual or potential effects on the financial statements. Therefore, the auditor has a responsibility to perform audit procedures to identify, assess, and respond to the risk of material misstatement arising from the entity's failure to appropriately account for or disclose related party relationships, transactions, or balances. In addition, an understanding of the entity's related party relationships and transactions is relevant to the auditor's evaluation of whether one or more fraud risk factors are present as required by Section 240, because fraud may be more easily committed through related parties, owing to the inherent limitations of an audit. I could just skip the readings and just only study the stuff that he addressed in class. I have basically 2 hours to do this. Owing to the inherent limitations of an audit, an unavoidable risk exists that some material misstatements of financial statements may not be detected, even though the audit is properly planned and performed in accordance with the rule. In the context of related parties, the potential effects of inherent limitations on the auditor's ability to detect material misstatements are greater because of the reasons such as the following. Management may be unaware of the existence of all related party relationships and transactions. Related party relationships may present a greater opportunity for collusion, concealment, or manipulation by management. Planning and performing the audit with professional skepticism as required by the section is therefore particularly important in this context, given the potential for undisclosed related party relationships and transactions. The requirements in this section are designed to assist the auditor in identifying and assessing the risk of material misstatement associated with related party relationships and transactions and designing audit procedure. We haven't even gotten to the requirements yet, dude. Really? And designing audit procedures to respond to the assessed risks. Dude, I have to read 30 paragraphs. Gosh. Which ones are important? I mean, according to him, he only covered nine and 10. That's dude, I could just skip most of this. You know, I could probably just skip most of it and just read 9 and 10. You know, I think I'm going to try a strategy where I only read I read the stuff that he talked about in class. But I read it multiple times rather than reading the whole thing once. I read the stuff he talked about in class multiple times. There you go. Check. This is funny. I'm going to eat jelly beans while I read this, and watch as eating the jelly beans distracts me from actually reading. Fun! Also, goodbye audio because That was funny. Wow. Events occurring between the date of the financial statement and the date of the auditor's report, subsequently discovered facts that become known to the auditor after the date of the auditor's report. Oh. Which ones? 9. No, he didn't talk about any of these. He just went straight to 15, 16, and 17. Well, we're going to go to 15, 16, and 17. So, that was funny. That was funny. Discuss the matter with management, and when appropriate, those charged with governance. Determine whether the financial statements need revision. And if so, inquire how management intends to address the matter in the financial statements. If management revises the financial statements, the auditor. Oh, really? Oh, come on. There's so much stuff. What is 13 anyways? Auditor should, if management revises the financial statements, should also either date the auditor's report as of a later date, send the audit procedure to return to the new date. Management revises the financial statements. Auditors should apply the requirements of if the audit financial statement. Dude, is he really going to ask us to explain the steps required if management revises the financial statements? That's a lot. That's a lot. I don't know if he's going to ask that. And if the audited financial statements before revision have been made available to third parties, assess whether the steps taken by management are timely and appropriate to ensure that anyone in receipt of those financial statements is informed of the situation, including that the audited financial statements are not to be relied upon. If management does not take the necessary steps, the auditor should apply the requirements of paragraph 18. If the auditor's opinion on the revised financial statements differs from the opinion the auditor previously expressed, disclose the following matters in an emphasis of matter or other matter. Paragraph. What the heck is that? The date of the auditor's previous report, the type of opinion previously expressed, the substantive reasons for the different opinion, that the auditor's opinion on the revised financial statements is different from the auditor's previous opinion. If management does not revise the financial statements, we need to revise. Then if the audited financial statements have not been available for management, those and if the audit financial statements have not been, then the auditor should notify management and those charged with government unless all those charged not to make the audited financial statements available to third parties before the necessary revisions have been made in a new auditor's report. When the revised financial statements has been provided, if the audited financial statements are nevertheless subsequently made available to third parties, if have been made available, the auditor should assess whether the steps taken by management are timely and appropriate to ensure that anyone in receipt of the audited financial statements is informed of the situation, including that the audited financial statements are not to be relied upon. If management does not take the necessary steps, apply paragraph 18, and he did not even talk about 18. Notify management and those charged with governance that the auditor will seek to prevent future reliance on the auditor's report. If despite them do not take them, then the auditor should take appropriate action to seek to prevent reliance on the auditor's report. That was funny. Written representation. Stop. Gosh dang it. Obtain representation from management. And when appropriate, those charged with governance that they believe that they have fulfilled their responsibility for the preparation and fair presentation of the financial statements and for the completeness of the information provided to the auditor, support other audit evidence relevant to the financial statements or specific assertions in the financial statements by means of written representations if determined necessary by the auditor or required by other AUC sections, and respond appropriately to written representations provided by management when appropriate. Those charged with governance, or if management or when appropriate, those charged with governance do not provide the representations requested by the auditor. Definition: a representation, a written statement by management provided to the auditor to confirm certain matters or to support other audit evidence. Written representations in this context do not include financial statements, the assertions therein, or supporting books and records. The objectives of the auditor consideration of omitted procedures after the report release date. The objectives of the auditor are to assess the effect of omitted procedures of which the auditor becomes aware on the auditor's present ability to support the previously expressed opinion on the financial statements and respond appropriately. Definition: omitted procedure, an auditing procedure that the auditor considered necessary in the circumstances existing at the time of the audit of the financial statements, but which was not performed. Requirements. Well, this is easy. Just 3 paragraphs. If subsequent to the report release date, The auditor should assess the effect of the omitted procedure on the auditor's present ability to support the previously expressed opinion on the financial statements. If the auditor concludes that an omitted procedure of which the auditor has become aware impairs the auditor's present ability to support when, as a result of the subsequent performance of an omitted procedure or alternative procedures, the auditor becomes aware of facts regarding the financial statements that existed at the report release date that, had they been known to the auditor at that date, may have caused the auditor to revise the auditor's report. The auditor should apply the provisions of Section 560, and that was easy. That was funny. That was funny. He just talked about 9 and 10. Wait. He basically just talked about 9 and 10. That's all he did for this section. That was funny. That was funny. That was funny. So, that was funny. The objectives of the auditor are to obtain an understanding of related party relationships and transactions sufficient to be able to recognize fraud risk factors. Recognize fraud risk factors, if any, arising from related party relationships and transactions that are relevant to the identification and assessment of the risks of material misstatement due to fraud. Conclude, based on the audit evidence obtained, whether the financial statements, insofar as they are affected by those relationships and transactions, achieve fair presentation, obtain sufficient appropriate audit evidence about whether related party relationships and transactions have been appropriately identified, accounted for, and disclosed in the financial statements. Arm's length transaction, a transaction conducted on such terms and conditions between a willing buyer and a willing seller who are unrelated and are acting independently of each other and pursuing their own best interest related party. Well, they don't define it. They don't bother to define a related party, do they? And they don't define it in A1 either. I looked in A1. Come on. You know what? Dude, what if one of the questions is define a related party? Why wouldn't they define it here? They could just repeat the definition. Come on. Come on. It says affiliates of the entity. Oh, come on. There's too many. One party having the potential to control the other party, exercise significant influence over the other party in making financial and or operating decisions. Gosh dang it. Two, 7, 15, 16, 7. Financial subsequent events and subsequently discovered facts. That was funny. those that provide evidence of conditions that existed at the date of the financial statements, those that provide evidence of conditions that arose after the date of the financial statements. That was funny. I bet I'm not even going to finish the memo today. Like, what? I mean, I don't know if he's going to accept a late memo. Like, I've never had any experience with this professor in terms of what happens if he turns something in late. The only things that we've ever had to do are either the Wiley Plus homework assignments, which he does not accept late submissions of those, and that's literally it. Or the McGraw-Hill thingies. So for those, he doesn't accept late, but he hasn't ever had assigned us some kind of project where, like this memo. So I don't know what's going to happen. Is there a late policy in the syllabus? Because if there is, I would be so relieved if there was a late policy here, because it's very possible I won't finish this. I already. Oh, man, this is so ambiguous. Does each memo have two problems? Or is the first memo the first problem, the second one's the second problem? There's no late policy. Late. Where's the late policy? There's got to be a late policy. Come on. Come on. Where's the late? Late assignments will not be accepted. Well, this is for pre-lecture learning. Optional review problems. Look at this. They're optional. I had no idea that they were optional. Like, I thought it was just a mistake or something. So late assignments won't be accepted for these, obviously. Related. Oh, come on. And yep, there's no late policy at all. The only late policy is for those. Really, you don't have a late policy. One of the most basic, most important things that you need to know. Five, 6, 2, 7. Date of the auditor's report. The date that the auditor dates the report on the financial statements in accordance with the date of the financial statements, the date of the end of the latest period covered by the financial statement, subsequent events. Events occurring between the date of the financial statements and the date of the auditor's report, subsequently discovered facts that become known to the auditor after the date of the auditor's report that had to be known to the auditor at that date may have caused the auditor to revise the auditor's report. And then 15. And also, I guess 13. We should probably just add 13, because 13 is referenced in 15 through 17. We have 12, though. Wait a minute. Wait just a sec. You just said subsequently discovered fact has to be after the report. What the heck? After the date. And then they say before the date right here. This is weirded. This is worded weirdly. It says before the report release date. What? Wait. This is the report release date is different from the date of the auditor's report? Oh, that's fun. The report release date is different from the date of the auditor's report. They should have defined that term. Date the auditor's report as of a later date. Extend the audit procedures. What? Now what are they talking about? It's so hilarious how they define the term date of the auditor's report, but they don't define the term report release date because apparently those two are two different things. Come on. Come on. The objectives of written representations of the order are to obtain written representations from management and, when appropriate, those charged with government. obtain written representations from management and, when appropriate, leadership governance that they believe that they have fulfilled their responsibility for the preparation and fair presentation of the financial statements and for the completeness of the information provided to the auditor. Support other evidence relevant to the financial statements or specific assertions in the financial statements by means of written representations. If determined necessary by the auditor or required by other agencies' actions, and respond appropriately to written representations provided by management when appropriate. Those charged with governance, or if management, or when appropriate, those do not provide the representations requested by the auditor for purposes. Written representation is a written statement by management provided to the auditor to confirm certain matters or to support other audit evidence. Do not include financial statements, the assertions therein, or supporting books and records. Assess the effect of omitted procedures of which the auditor becomes aware on the auditor's present ability to support the previously expressed opinion on the financial statements and respond appropriately. Omitted procedure, an auditing procedure that the auditor considered necessary in the circumstances existing at the time of the audit of the financial statements, but which was not performed. Requirements: if subsequent to the report release date, the auditor becomes aware of an omitted procedure, the auditor should assess the effect of the omitted procedure on the auditor's present ability to support the previously expressed opinion on the financial statements. If the auditor concludes that an omitted procedure of which if the auditor concludes that an omitted procedure of which the auditor has become aware impairs the auditor's present ability to support a previously expressed opinion on the financial statements, and the auditor believes that there are users currently relying or likely to rely on the previously released report, the auditor should promptly perform the omitted procedure or alternative procedures to determine whether there is a satisfactory basis for the auditor's previously expressed opinion. The auditor should include in the audit documentation the procedures performed in accordance with the presumptions. When, as a result of the subsequent performance of an omitted procedure or alternative procedures, the auditor becomes aware of facts regarding the financial statements that existed at the report release date that, had they been known to the auditor that day, may have caused the auditor to revise the auditor's report. The auditor should apply the provisions of Section 560